Hello and welcome to part 7 of Trading Commodities. I am Keith Harwood for Option Hotline, where research meets strategy. Today I'm going to talk about position sizing and incorporating options into these trades that I've been talking about in the commodities. Before we get to that, though, to the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read the rest of these in just the next few moments. All right. I should have given you enough time, especially since you probably already heard those 6 times. I'm Keith Harwood. Little reminder of who I am, and I want to talk today about position sizing and how I really use math to do my position sizing. So I went to college at the University of Notre Dame, and so some of you probably love me and some of you hate me as soon as I say that, but I was a theoretical math major as well as economics, so a lot of statistics, probability, things like that, incorporating a lot of analytical approaches to everything I do. When I went to the University of Chicago for my MBA, my focus was on econometrics and statistics, as well as analytical finance and entrepreneurship. So again, really a focus on a lot of these analytical elements, and I find that I tend to do better when I can incorporate math into what I am doing. That's part of why I like technical trading. It's very mathematically focused, but also kind of takes into effect of basically putting math behind market psychology. So that's what we're doing with technical trading, right? Is we're looking for something that's going to change the psychology of the market, and how can we get a numerical interpretation of that or a numerical representation of that? Well, now, today, focus is on, as I said, the sizing, and how do we take a mathematical and analytical approach to that to figure out the best way to size these trades. So what we're going to talk about today is how I do a basic position sizing, and then how do I incorporate options to optimize my sizing as I go through these trades. ETF structure is very simple. 100% of my capital goes into the trade that I've devoted to this trade. So if I have $5,000 and my signal is long, I buy $5,000 worth of the ETF. And if my signal is short, I short $5,000 worth of the ETF. That's simple. That's not too hard. It's just put the capital into the trade. What about with options, though? Because if I put 100% of my capital into out-of-the-money options, they could go to zero. I can't see that being a good investment. Just because I can buy $5,000 worth of out-of-the-money calls expiring in a day doesn't mean I ever should. And when I think about the structures that I can apply here, don't different structures actually dictate different sizes, and don't different setups dictate different sizing? So how do I apply those different logics to my sizing? Well, there's a few different methods that can be applied. And I'm going to walk you through a couple of them today, a couple that I like to use, because those are the ones that I think help me structure these trades better. So first off is delta-based. So in a delta-based system, I just do a simple calculation so that I can have an equity-like portfolio. So if I think implied volatility is relatively accurately priced, the market doesn't look like it's going to have a big deviation from where the options are priced. The options are priced well. Then I kind of just want something that's going to be a little bit more like an equity position, but I can still leverage that by structuring something unique with skew or something like that. But the number of options that I do, let's say it's just a single option, I just take my account size, so let's say it's that $5,000, divided by the ETF price, and then again divided by the option delta. So if my ETF price is, say, $20 and I have a $5,000 account, well, 5,000 divided by 20, that's $250. If my option delta is 50%, now I'm at 500, but I got to divide it by the multiplier here that I didn't include here. So the option delta, when you look at that option delta, think of it in terms of it can range between the number 1 and 100, not 1% and 100%. So if it's a 50 delta option, it's 5,000 divided by 20 is 250, divided by 50 is 5. So I'm buying 5 options, 5 50 delta options in a $20 ETF is the same as just having that stock position. Usually I'll go a little more complicated than that, though. Maybe I'm putting on a call spread. It's a 60 delta call spread, and I got to do a little bit more work on this. But that's the idea. Is if I'm just trying to replicate something similar to a stock move because the market's kind of priced right for the opportunity. What if it's not? What if I think that there's a really big opportunity coming here? Like I'm looking at short-term options, and I can get a lot of leverage with those. So when I use like the home run swing trading program, I'm looking for that lot of leverage on those couple week out options, okay? So if I think there's a bigger move potential, I want to use this kind of system because this is where I get my leverage is by applying a bit more of a different approach. So rather than saying I'm just buying 50 delta options, I determine how much capital I want to risk. So I want to risk $100. And these out of the money calls are 10 cents, which is $10. That means I get to buy 10 of them. What if I see some that are like 3 cents, so $3? I get to buy 33. That's where I can get some leverage. Okay, so if I'm looking for something with real leverage, I want to use this approach because it allows me to apply a bit more risk when the market opportunity is more exciting. So I use this when the opportunity is exciting and when volatility is mispriced. So I have to have a misprice in volatility relative to my expectations. Really good technical setup, and I want to use more leverage. That drives me towards dollar cost sizing. I can't really do that, though, in some trades. Like complex trades, dollar cost sizing doesn't always work. And deep in the money options doesn't really work. So this is more of a structure that I use for those out of the money options when I want real leverage. How about risk-based? Because this can be applied if I have a true stop. I don't really always have a true stop, though, in these structures that I've talked about. I'm either long or short. So if I'm always long or short, my signal tells me when to flip. So it's a little harder to apply this kind of strategy for an outright option. But what if I want to have a little more complicated structure on it? So if I was doing it with a stock position, I would just take the total trade risk in dollar terms and divide it by the stock price minus the stop level. That gives me how many shares I can do this. So I could take that and then do a delta equivalent, or more importantly, what if I'm doing something complicated? And I really want to do something with like a straddle or a strangle or something weird. Let's take a look at an odd example. Let's say I think that the market is somewhat mispriced here. So I think that the market on whole the options are way too cheap, but I want to have protection because I'm not sure if this is going to be the big blowout move to the upside in oil. Well, rather than just buying some calls, I can do something with a ratio here where I've got a net long delta, 316 delta in this $15 ETF, so that's about $5,000 worth of delta. Okay, so that's that delta-based system. My total cost on this sort of trade would be $542. I can't really use that dollar risk thing because I'm not really risking $542. I'm looking at this for a couple of days and saying, well, if in the next 4 days we go down, or the next 7 days we go down, I'm really risking closer to $175. So I have to look at this risk slide to figure out what my real risk is once I've adjusted for that delta risk. So I know that my delta risk here was about right for a $5,000 portfolio. And then I double check my risk and say, okay, I'm really only risking about $175, and I'm comfortable with that based upon a risk-weighted system. So I have both of these coming into play, even though neither of them completely accurately portrays my position. This is where that nuance of options really kicks in, because if I understand the skew and the vol levels and everything else here, and I can put together a nice position, I want to play that because I got to take a look at this overall risk. There's extra risk as well, such as vega, theta. The theta is shown here because this is just if the market goes down, we've got delta risk and theta risk. It doesn't account for skew shifts and vol shifts because then you'd have this four-dimensional picture that I can't show you. It's hard to visualize. So what I want to do when I put together one of these complex positions is really evaluate what my worst case scenario would really be for 3 to 7 days and then use that total dollar risk at that point. So I start with a delta, knowing I want to get to $5,000 worth of delta. Then I set a new dollar risk based upon how I've structured my trade. And then I have to put together all these little widgets to get the right dollar risk that represents my delta for this trade. Because it might mean that instead of doing 7 by 15, 7 puts and 15 calls, that I have to go smaller. Maybe I have to use 5 puts and 12 calls to get the right dollar risk in my trade without drastically altering my delta. I know it gets complicated. This is what I spend my time doing for the core commodity stuff is I want to find the best use of options leverage in the market. What's my baseline trade setup? Where do I start? So remember, the delta weighted was replicating just an equity position. The dollar weighted is one that I use for when I want to get a little bit more leverage, and risk weighted I'm using when I'm trying to come up with a complex position. It's delta weighted, right? Delta weighted is the baseline. Dollar weighted comes when there's leverage. Risk weighted comes when there's complexity. All right, folks. Last section up next, managing the trade flip. Because as I said, I'm either always long or short, never out of the market. So how do I handle that flip from long to short and continue keeping this trade running the way I want?